Brian Shannon from alphatrends.net. Today is Friday, the 4th of March, 2022. Hopefully you had a better week than the market did this week. We saw some pretty good weakness, especially in the semiconductors, which were down 5.5%. As we know, they have been leaders over the last couple of years, and now they're turning into a leader to the downside for the semiconductors, and that does not bode well for the rest of the market. We also lost significant ground in the financials. That group looks terrible. Let's take a look at the market. The S&P 500, we're still in a downtrend. We get some good bounces and downtrends. Nobody will deny that. But the fact is, the pattern is still lower highs and lower lows. Recognize that some of the most powerful rallies come during downtrends, but they're destined to roll over and fail, or at least test the lows, and they need time to heal. They are not going to turn right around with a declining 20 and 50-day moving average typically, and we're of course below that pink year-to-date volume-weighted average price as well. Looking to the 30-minute time frame, we had some really good movement off of some key levels this week. First, we saw that the volume-weighted average price off of last Thursday, when when the bombs started dropping, that market was bought. We came down and tested that. That's exactly what we were looking for over the weekend. That level would provide an area of support, and it did. In fact, we saw a significant bounce up to the volume weighted average price from the January 24th low, and then today we lost ground once again, closing right around the volume weighted average price from that prior low. Next week, I think that if we break below the low of this week, it could be bigger problems for the S&P 500 and perhaps a test again of that September of 2020 volume weighted average price. There's nothing here that I can see that's encouraging in these markets. The Nasdaq also came right up to that 20-day moving average, and when we look at the 30-minute time frame, it was pretty much precisely at the volume weighted average price from the January 24th low. This is why we keep an eye on those levels, because they become significant on test, and that's exactly what we saw again. Prior to the test of that volume weighted average price, we had seen the same exact thing in the Nasdaq, in that the volume weighted average price from last Thursday's low, February 24th, was tested, and we saw a significant bounce right up to the January 24th volume weighted average price. These moves are not a coincidence. Today, what we saw is a little bit disturbing here, in that this is what I was kind of looking for. I'd sketched out for subscribers Thursday night, but what we saw was that we broke below the volume weighted average price from last Thursday, and then we rallied up, got rejected there, and now we have a pattern of lower highs and lower lows below a declining 5-day moving average. As long as we're stuck below 340, I think you've got to be super cautious with this market. It seems highly likely that we come back down to at least this volume weighted average price, if not from the COVID low, which is down near about, what is that level right now? Oops, I might as well just get rid of that since I messed it all up. 316, 317 is the volume weighted average price. That's 20 points lower. It's still, we're still talking about 7% downside to test that, and it seems more likely than not. The path of least resistance is lower. Things can change. That's why we manage risk, but the path of least resistance is lower. It's guilty till proven innocent. The Russell 2000, same story. We came right down to the volume weighted average price from the COVID low. That, of course, also coincided, as we've noted, with the 38.2% of this move from this low up to that high. 38.2% occurs right here. That's what this level is. 50% right here, and 61.8. Those are just basic Fibonacci retracements. But the fact is, we came right down to that volume weighted average price, just like we did last month, and bounced significantly from there. So when we look at that on a shorter term time frame, it kind of did what it was supposed to, kind of, in that it came up to, that the volume weighted average price from last week's low held for a place of buyers. It rallied up. That rally came very close to, or actually up through, the year-to-date volume weighted average price, but we're still in a messy market, so we look at it as likely to fail, which it did. We made this pattern of lower highs and lower lows, and we are stuck below this volume weighted average price. 200 is going to be needed to be overtaken in order for this market to become neutral, and bullish is still just not fathomable right now. So again, we have a declining 20 and 50-day moving average. Semiconductors are a real concern here. They are clearly in a downtrend. These are yesterday's news. They are no longer the leaders. They have been coming down to this volume weighted average price from that September of 2020 high. We've noted that several times before. That's where the buyers keep showing up. It seems likely that they'll break, and if they do, then I think, the COVID low volume weighted average price is still a little too far away to think that that's a realistic place that it would go. Maybe from this gap right here, that had been important here, and that would tell me that maybe we're headed for about 244 and a half, 245. So again, we're below declining 5-day moving average. You can see that this market had a lot more trouble with the volume weighted average price from the February 24th low, and we're stuck below it. It's declining. It's guilty till proven innocent. It's going to need 264 just to become neutral. By the way, if you're following and watching on YouTube, please subscribe, like, comment, etc. It helps these stocks move up in the algorithm, I'm told, at YouTube. Biotechs just continue to be in a horrific stage 4 decline. There's nothing encouraging about this market. It's lower highs, lower lows. The most recent rally was capped at the year-to-date volume-weighted average price, and this week it was unable to get up to the declining 20-day moving average. Looking to the 30-minute time frame, same story here. This was an important event. The buy the bombs worked for a little while. That held his support on the first test, and then it hammered at it, and sellers gained control. We're below a declining 5-day moving average. We're guilty till proven innocent. 125, if it gets and closes above there, this market becomes more neutral. It doesn't become bullish. You need a lot more for it to become bullish when you're in a severe downtrend like this. Financial stocks look terrible. They keep coming down to this volume weighted average price from January of 2021. They look a lot like the Russell 2000 did back in, probably back in, this area over here. This is where it looks to me like the financials are right now in their life cycle. Then maybe they get a little bit further bounce in here, but what you can see is we're trapped below that blue and green 20 and 50-day moving average. We're trapped below that pink year-to-date VWAP. We're trapped below this 200-day moving average. That 200-day moving average is starting to flatten out. That is not a bullish thing. We keep dancing on the volume weighted average price from January of 2021. The more time support is tested, the more likely it is to fail to hold, and it seems likely that we could come down to this next level near 36. A lot of destruction in these individual names. JP Morgan, I had pointed out, I think on Monday, saying that, here's a stock I would be nervous if I was long, and it just got destroyed. I guess that was actually last week, because I pointed out basically right around in here before these big drops. But just it's yesterday's news. It's over for the banks for now, at least. They look very similar to technology stocks did, and if you're involved in these, if you're heavily weighted, don't get trapped in here the way you may have allowed yourself to get trapped in technology names. It's just not worth holding on to these, even if you consider yourself a longer-term investor. Energy names continue to move higher, as we noted last Thursday. They gapped lower with the rest of the market, and buyers came in right at the year-to-date volume-weighted average price, and we have been ramping higher since then. I've been calling them, up too much, overbought, whatever, due for a pause, a correction, but definitely not worth shorting. So I still think it doesn't make sense to buy not this, but for instance, today I bought LPI, and this is one I had mentioned in the Investors Business Daily meeting this morning, is that LPI, it looks like it's been lagging, but if you actually look at the weekly time frame, it's been a beautiful winner, and it is lagging on a much bigger time frame. Perhaps it's headed up towards this level. I'm not an investor, so I'm not looking for $150, but it certainly looks reasonable. I think that if it can get up, to this breakout level, that if you're involved in here, then you want to sell a little bit to the breakout chasers. The fact is, there's still opportunity on both sides of the market in here. As we know, gold has broken a significant level. I've been talking about that on Twitter since the breakout right here 3 weeks ago. So there's still opportunities out there. I hope you're finding them, and I hope you have a good weekend. I'll talk to you next week.